Hey there, and welcome to Real Investment News. I'm Mike O'Neill. So for the past month or so, we have been closely watching the S&P's 200-day moving average, this green line right here. As we said, it has been serving as a good point of resistance for the markets. Let's rewind actually. This is January when we hit those record highs, and then we started tanking. The market never quite hit that 200-day moving average, but as we move along, right here, it looks like we actually touched on it right at the end of March. You can see we dipped below it briefly at the beginning of the month, but now we are climbing well back above. We actually just crossed over the 100-day moving average. That's actually good. But why do we pay so much attention to this mark in the first place? Well, Lance Roberts talks about the importance in today's post, Selling the 200-Day Moving Average. Now, the 200 DMA is a good line in the sand for investors. Lance's recommendation when the market crosses below that line means it's time to make a move to cash, but we're not talking about selling everything. We're just talking about basic management risk. For example, trim back your winning positions to their original portfolio weights. Also, sell the positions that are not working, because if they're not going to be working in a rising market, they're probably not going to go up when the market is declining. And hold on to cash until the next big buying opportunity. It's a relatively simple strategy, but it does make some investors nervous. And that's because the markets actually cross that 200 DMA more often than you might think. Now, here's a chart of the S&P dating back to April of 2008, 10 years ago. Now, the market is the blue line. The red line is the 200 DMA. And even with this unprecedented bull market, it has actually crossed below it 6 times, as you can see right here in 2011 and again right around 2016. Now, it would mean that that is the time to make your adjustments. And when the markets cross back over, well, you start buying your way back in. We should note, though, that just because the market dips below the 200 DMA doesn't mean that they're crashing. Oftentimes, it's just a small correction. And, of course, as I've said before, we haven't seen any major corrections since 2009. So, you may be asking, why not just a buy and hold? Well, because this market is kind of the aberration. We've never seen a bull market last this long before, and it surely won't last. So, imagine if you had invested $1,000 on the S&P back in 1997. And this chart actually just tracks the capital appreciation only. Now, if you follow the simple buy and hold, riding out the big drop, say you saw after the dot-com crash in 2001 and the housing meltdown in 2009, well, by the end you would have about $4,000. But if you had switched to cash when the market broke the 200 DMA, even with the higher trading costs, look at this, you would actually have more than $10,000 at the end. So yeah, there would be times when you lost money. It can't realistically be avoided, but look at the difference just a little bit of a strategy can make. As always, you can take a closer look at these charts, read more of Lance's analysis and his strategies on the website, realinvestmentadvice.com. But for now, that's it for me. Thank you so very much for watching. Please remember to follow us on Facebook and Twitter, YouTube. Check out our past reports at realinvestmentnews.com. I'm Mike O'Neill. We'll see you again in a couple of hours.